Hello guys, welcome. In the previous session, we learned about mergers, acquisition and absorption. We saw the meaning and the types of merger. In today's session, we're going to see the meaning and types of acquisition, advantages and the step-by-step process of how how acquisition is being done. So we'll just delve into it. Acquisition is a corporate strategy where a company acquires majority or full ownership of the target company in order to assume its control. So, acquisition, just like merger, means combination of two or more companies. But in merger, unlike acquisition, after the combination happens, either one or both of the old companies will be extinguished. For example, if there are two companies, A Limited and B Limited, after the merger, either A Limited and B Limited will combine to form a new company called C Limited, and the A Limited and B Limited will be extinguished. So those two companies will be dissolved and the new company will be incorporated. Uh, that's one type, and another type is either one of those companies, say B Limited, will be extinguished, it will be dissolved, and all its assets and liabilities will be transferred to A Limited. So those were the two types. But in acquisition, no such extinguishing happens. In acquisitions, it's simply like one company will acquire new company and the existing company may or may not choose to exist. Okay, so the target company, or in other words the acquired company, will exist even after the acquisition, and it will become the subsidiary of the company that acquired, the purchasing company. So just like merger, the same objective, that acquiring a company is economical when compared to building a company from internally. So if you have a company and you have some plenty of cash in your reserves, and if you want to expand your business, expand your product, expand the market that you are selling to, or you are trying to start a new product, so on and so forth, it will be easier to, instead of founding a new manufacturing unit or founding a new research and development, it will be economical to buy another company that is about the size that you would want to expand. So that is the main objective of acquisition. So we have some types of acquisition, we will see that in detail. Friendly acquisition. Friendly acquisition means the firms involved in the acquisition agreed to it friendly and cordial. There is no forceful decision making. So the acquiring company will have the full consent of the acquired company or the target company. So the target company will give its full consent to be acquired by the acquiring company. So the acquiring company then will, with the help of the target company, buy the majority shares of the target company and become its parent company. So that's how a friendly acquisition happens. So now you can ask, is there any possibility that the target company may not be willing to sell its own business, but is it possible to take over a company without its own wish? Yeah, it happens. It is called hostile acquisition. So hostile takeover happens once in a while in the business area. So hostile takeover means nothing but the acquiring company or the purchasing company will have enough cash to buy the majority of share in the target company without even the wish of the target company. So sometimes it happens even without the knowledge of the target company, because any company will be founded by one or more individuals, and those individuals are called the promoters. So the promoters will hold a considerable amount of share in the company. So after a company becomes big, and when it goes public or when it goes private, after it issues its shares to the general public, the ownership percentage of the company will become less and less with respect to the promoters. So initially the promoter will have 100% ownership of the company, but after it tries to uh, get new funds, get more funds from the public, it has to sell its part of its ownership as shares. So the more shares the promoter sells, the more shares, the less ownership they have in the company. So after once the company becomes big enough, the promoters will hold only about 30 to 40%, anyways less than 50% of the company that they have originally founded. So in that scenario, even though they are the promoters and the biggest shareholders of the company, they do not have the majority shareholding in their own company. So in that scenario, a company that has enough money to acquire all the shares, all the remaining shares that the promoters do not hold, will be able to buy those shares against the wish of uh, the promoter. So this happens when the public, the general public who are holding the shares of the company, is not happy with the actions of the promoter, or they do not see that the promoter's main goals will not reap benefit to the company in the foreseeable future, or if the acquiring company offers more profit or more stability than being done by the promoter. So if the public shareholders feel that way, they will let the acquiring company buy the shares of the target company without even uh, expecting the willingness of the promoters. So that is called hostile takeover. So reverse acquisition means when a private company acquires a public company. So generally the opposite happens. Public companies only acquire private companies, and after the acquisition, everything that the private company holds become a public company. So public companies, as the name says, will have public shareholders. The public company can issue shares to the public and they can raise funds eventually. So the public company is generally considered to be bigger than the private companies, because the private companies will only have 200 owners or 200 shareholders. So there is very little amount that the 200 shareholders can raise. So in that scenario, mostly the public company purchases the private company. So but in this case, it is called reverse acquisition, wherein a private company acquires public company because it will have enough resources, it will have enough funds to do that process. So next is backflip acquisition. So this is a very rare type of acquisition where purchasing company becomes the subsidiary of the target company, the purchased company. So when I said in the definition of acquisition that the purchasing company will buy the target company and make it the purchasing company's subsidiary. So that happens a lot, like in Flipkart Walmart deal, or in Vodafone Hutch deal. Hutch becomes a part of Vodafone. So and Tata and Jaguar Land Rover deal. So Jaguar and Land Rover becomes the part a subsidiary of the Tata conglomerate. So that's how generally acquisition happens. But in backflip acquisition, the purchasing company becomes the subsidiary of the target company. So the purchasing company, after generating enough funds to purchase the target company, will announce itself as the subsidiary of the target company. So that is called backflip acquisition. So here are the few steps that is being mentioned as step-by-step process of merging and acquisition. So for both merging and acquisition, these steps are to be done in order to perform the mergers or acquisitions. First one is analysis of clients requirements. So client in this place means the either the purchasing company or the target company, but mainly the purchasing company. So client refers to the purchasing company, and their require means what are all the what ideas do they have about purchasing a company. So the purchasing company will have certain ideas of what kind of purchase that they need to make, what kind of companies they would want to acquire, whether it is the company that manufactures the same product in a different market, or a different product in the same market, or a similar product that both of the target and purchasing company's product will end up in for same finished product. So that those were the requirements of the purchasing company. So to analyze that is the first step, and the second step is to generate ideas of what kind of businesses to buy, whether it will be a public company or whether it is a subsidiary of another company, or whether it is a startup, or whether it is a new and emerging company that has enough funds, and the that companies are also looking for acquisition and so on and so forth. So uh, a company has to come up with many ideas and they choose the best one among them. Third step is valuing companies. So company valuation means the valuing what the target company and the purchasing company is worth in monetary terms. So we know that a company will have its balance sheet, its assets and liability statements. So that basically explains everything that a company possesses and liable for. So what it possesses is called assets, and what it's liable for is called its liability or the creditors. So valuing company involves the total valuation of the assets and liabilities of the companies. So in net asset method of valuing companies, a person will find out the asset value of the purchasing company and the liability value of the purchasing company, and they settle it. So for example, if your company has assets, fixed assets, inventory, cash deposits, and others worth about 10 crores, and you also have liabilities such as capital, investors capital, loans from bank, loans from other institutions, debentures, and the creditors, so on and so forth, worth about 7 crores. The value of your company is 10 crore minus 7 crore equals 3 crores. So this is called a net asset method, and there are other methods such as intrinsic value methods and so on. So valuing companies is a huge deal, so much so that there is a separate job category, there is a separate career of people doing the valuation process. There is a separate degree to study about how to value companies. And the fourth step is identifying potential partners. So unlike hostile takeovers, not all the acquisitions happen without the consent of the target company. So in most of the acquisitions, the target company will be willing to uh, partner up with the acquiring company. So in such cases, the acquiring people will have to find who are all willing to be partnering up with the acquiring company. So they will find a list of the potential partners, and they will canvas them, or they will negotiate with them to make that merger happen. So fifth one is drawing up documentation. Documentation is nothing but uh, agreement between purchasing and purchasing and target company. So that agreement or the contract says what will be the amount of the purchase, how it will be settled, and when it will be settled, and who will be the beneficiaries of that kind of payment, and so on and so forth. For example, if a startup is being bought by a $1 billion company, let's say Google or something, so Google can choose to pay the startup owners with money, or Google can choose to pay the startup owners with the shares of Google, or debentures, so on and so forth. All of those details will be entered in a contract, and those contracts are called documentation. So documentation is an important step because it acts as the proof that the company has been acquired, and it also acts as a proof in future that if the purchasing company is willing to uh, distinguish the target company, or extinguish the target company, uh, but because if the contract says that the purchasing company does not have the power to do so, the purchasing company cannot make that happen. So those details will be included in documentation. Next one is due diligence. Due diligence means it's just a report saying whether all the rules that has to be followed for acquiring that company has been followed, and all the amount has been paid. Everyone who is liable, or everyone who is supposed to get paid from the acquisition, whether they have been paid, and the rules, the acquisition rules, merging rules, with respect to the place of the location of the companies has been followed or not, will be included in the due diligence certificate. Second one is supporting management. So supporting management means step-by-step process of how the acquisition has to happen. So first step is to negotiate, to find the target company, and the second step is negotiate a target company. Third step is to have enough resources, to generate enough resources, to generate enough funds to make the acquisition possible, to pay for the target company, and so on and so forth. So these kind of steps to needs to be taken by the management of the purchasing company. So that needs to be done. And eighth one is conducting negotiations. So what is the final amount that the purchasing company is willing to pay the target company? What is the value, like in monetary terms? So if the target company asks for, if it is valued for 3 crores but it asks for 3.5 crores, the purchasing company has to do some calculation whether it will be worth it to pay more than what it is actually worth for. So if the purchasing company still feels that it is still worth more than what we are paying, then they can continue with the acquisition. So Motorola has been bought that way. Motorola was bought by Lenovo for more money than it was actually worth for at that time. So a lot of acquisitions happens that way because the target company will have a big future, and the acquiring company will have confidence that the target company will shine in the foreseeable future. So that happens. So reasons for merging and acquisition. The main reason that was stated for merging and acquisition is called something called a synergy. Synergy means a condition where 2 by 2 equals 5. So you can ask, how is that possible? Sometimes it is possible because the combined value after the, I mean, if you take a valuation of the company after the acquisition, that will be more than the value of the individual companies before the acquisition happens. So if A and B are worth each 2 crore each, after the acquisition, after the company becomes C, the valuation of C will be 5 crores. So how could that happen? That can happen because some of the liabilities of A will be settled by the when the acquisition happens. A lot of liabilities such as tax liabilities and debenture liabilities, so on and so forth. Anything that either of the companies needs to pay, they will have an option not to pay if the acquisition happens. So those are all strategies that the corporation finds. So one of them is called tax bundle, I think something tax bundle. So that means it is mentioned in here. So that tax benefit means if the purchasing company has had a profit and the target company has been having losses over the years, the profits of the purchasing company can be set off against the losses of the purchased company. Therefore the purchasing company doesn't have to pay tax anymore until the whole loss of the purchased company has been set off. So this kind of benefits arise out and result in the overvaluation of the companies at the end. So this is called a synergy. Uh, there are two kinds of synergy. Operational synergy means cost savings that occur because of increase in turnover and profits. So maybe one company can sell like 1,000 units of a product per month, and another company can sell like 500 units of product per month. And if they choose to combine together, after the combination they will have more market and they will have more turnover and they will have more ability to manufacture items, they will have more employees. So combining all together, if you have the right amount of control and push, you will be able to manufacture up to 2000 units of products per month. So that is more than the combined value of the two companies before the merging or acquisition. So that is called operational synergy. So how the company operates after the acquisition, how the company benefits from operational activities after the acquisition is called operational synergy. Financial synergy means what are all the financial advantages they have because of the acquisition. So one of them is lower taxes, high debt capacity, better use of resources. So some of the resources that the target company has may not be available for the purchasing company. And like I said, the if the purchasing company has a lot of tax liability, if it has a lot of profit and they need to pay a lot of taxes, if the purchased company or the target company has a lot of losses, then the profits can be set off against those losses. It's called financial synergy.